Welcome to the latest episode of Dalal Street to Wall Street. I'm Shubha Maulik, the founder and CEO of Appreciate. And with me is Vikas Gupta, the founder of OmniScience Capital. We're going to be in conversation about investing framework Vikas has developed, the scientific investing framework, which is fascinating. So Vikas, let's get into it. But if you can just do a quick intro yourself.
Pleasure to be here, first of all. So the scientific investing framework is something we have developed over a number of decades, actually. The idea behind it is very much focused on fundamental investing, or as you would say, the origins even lie in value investing. But now value investing and what we do is now, it's based on that, but it's evolved significantly beyond the old style value investing, or even what is called the new style value investing. So old style as in buying things at low price to book, or the new so-called new value investing, which is already old in our opinion, which is buying quality companies, right? Buying moats, and which is where for last 10 years we've been having a tussle with, intellectual tussle, nothing that people who used to buy quality companies or moat companies at any price. So we said that is QRAP, quality required at any price, which means scrap, right? And so it will lead to bad results. Buffetology is buying quality companies at significant discount to their intrinsic value, or as he says, buying great companies at great price. Or buying great companies at fair price.
Right.
But you can't buy great companies at extreme...
inflated prices, correct.
Yes.
Correct. So I think the other piece that I thought was also quite fascinating was your observations on the value of safety, or the value of discarding rotten apples, right? So talk a little bit, because the insight seems counterintuitive, though I don't think it is, which is, hey, if you prioritize lower volatility, safer companies, you can actually see greater returns. Normally people chase returns and say, hey, okay, if I chase returns, maybe I don't know volatility. You're saying, no, chase the volatility, chase safety, it'll actually lead to higher returns. So say a little bit more about that philosophy, which resonates with me.
Yeah. So like one thing we have, which is the slogan of OmniScience itself, is science of alpha from safety. In equity markets, everyone talks about returns and rarely they focus on safety. But the whole thing is based on an insight, which we call the Omni Insight. And what Omni Insight says is that most market participants chase alpha, but end up with risks. While you could chase safety and end up with alpha. So there is this idea that high risk, high return, low risk, low return, and which we agree with on an asset class level. So low risk asset class like fixed income, and high risk asset class like equity.
Correct.
High risk asset class like equity has higher returns. Low risk asset class like short term fixed income has lower returns. There's no question about it. But as soon as you come into an asset class, then this no longer applies. Then rather the safer the companies, and we are talking fundamental safety here. So while volatility is fine, that is one definition. But if you just think like a businessman, what is the risk in this company? Let's say it was unlisted company. Then how will you figure out what is good or what is bad in your portfolio of companies? Let's say you're private equity, you have 25 investments in different kind of businesses. Every quarter you will get their financial statement. And you will say, are their revenues better than last year? Are their earnings better than last year? Are their cash flows better than last year? Are their net worth of the companies increasing? Right? If all of this is happening on a sustainable basis, then it looks fine. If there is too much debt happening, if there is too much losses happening, then you say something is bad. Right? So the same analysis we do for equity markets.
Correct. And I think key to this, right, which is finding return through safety, is your concept of, hey, let's focus on capital multipliers, let's avoid capital destroyers, right? So maybe you can tell the audience a little bit about that, because that's also, I think, quite interesting.
Sure. So this framework, so I'll just explain the framework so people are clear what do we mean. So let's say we take S&P 1500, which people might not be familiar. Even a lot of US guys are not familiar with S&P 1500. But S&P 1500 is S&P 500 large caps, S&P 400 mid caps, and S&P 600 small caps. All put together is called the S&P 1500 Composite Index. So that's our investment universe. Typically, we pick from that, right? Rarely we'll pick from outside that as well. But now take these 1500 stocks and you need to now go for a selected portfolio from this. And people would say ETF ka zamana hai. People say ETFs, we love ETFs. Why don't we just buy a tracker, right? So the problem with that is in this 1500 stocks, there are a lot of companies which we call capital destroyers. What are these capital destroyers? These have huge fundamental risks. They're consistently loss-making companies, consistently negative cash flows, and highly leveraged balance sheets. And they're still listed, traded on the markets. And there are hundreds of these guys in S&P 1500. So if I take these guys out, I am left with maybe 500-700 at least are gone out. That many bad companies are there. Now, how do I say they are bad companies? If you look at the credit rating, it will be very bad credit rating. Okay. Now, the reason the bad credit rating means that their debt holders are going to lose money. So, if debt holders of a company are going to lose
then the
money,
equity holders aren't far behind. Actually, they're ahead of them.
What will happen to you? You are completely zero. At least they have a fighting chance. They will, after bankruptcy, they'll get something, right? Maybe return of capital, 30% ROC. But off capital, at least you invested 100, you got 30. Shareholder is wiped out. So this is capital destroyers because shareholder is completely wiped out. So safety and higher returns at the same time. Next is the eroders, what you mentioned. So eroders are now not from this. 700-800 companies are gone. From the remaining, the companies which are not earning even the cost of capital. So the question is, why are they? But they're still listed, traded, they're doing business, they're earning profits, and they're paying taxes. But why are you doing this? You might as well go and invest in treasuries.
Correct.
And you'll make the same amount of money without all this headache of running a factory and having thousands or tens of thousands of employees and all that. So eroders don't earn cost of capital. 300-400 of those are gone out.
Yeah.
Last year left with. Now this is where you will have the biggest intellectual fight, which I just mentioned at the beginning also. Half Buffettology. Capital imploders. Now all the companies are great companies, right? They have strong balance sheets. The business-wise, there is no risk.
Correct. But the entry prices are quite different.
Exactly.
Compared to potential value generation.
Exactly. So something, let's say this is one of the best. I give example from real estate to explain this to people because otherwise they don't get it. They say, oh, and real estate is more people do real estate or they have an intuitive feel. So I say, okay, there is a very, very good flat somewhere in Bandra, which is 25 crores worth. And you think this is the greatest location, so it should be 25 crores, no problem. And you are willing to pay. But when you go to buy it, somebody says 27. So fine, I'll give you 27. But then people say, no, 30. Say, fine, I'll give you 30. It keeps going up and up and up, 50, 70. At some point, that best location in Bandra flat, with all the best of the best things, at 100 crores, 125 crores, something which is worth 25 when it's selling at that kind of thing, it's definitely going to be a loss-making proposition, right? At what point do you want to cut and say no more for me? For someone like me, it will be 25.5. But for someone else, it will be 125. But somewhere you have to know that I have crossed all limits.
Yeah.
So it remains the best business or it remains the best flat, but it's no longer worth investing.
So let's focus a little bit on your capital multipliers, right?
Yeah.
Companies where you based on your framework, are saying, yes, this is worth investing. And there are a handful of companies. So if you start with 1,500, you're probably down to 80, 70,
Absolutely.
something of that sort,
Yes,
right?
yes, in that range.
So talk a little bit more about the process of getting there, right? Like what are the factors that make Capital Multiplier stand out? And maybe give us a few examples in the last half a decade or so.
Sure, sure. Yeah. So as you start taking out all the junk, right? The destroyers are out, eroders are out, and imploders, which is basically high quality but extremely overvalued companies, those are out. These are the typical darlings of the market. These are the ones which are traded heavily.
Mhm.
So if you talk from a broking platform point of view, that will be what you will see the highest volume. Everyone is buying and selling like crazy. And then there is these multipliers, which nobody is paying attention to. Fundamentals are strong. Balance sheets are strong. Fine. Now, within this multiplier, still you have to do a lot of stuff if you want to have extraordinary alpha. Your 3 notches alpha already, because you have eliminated destroyers, eroders, imploders. So 3 levels of alpha and 3 levels of lowering of risk at the same time. But still one last step is remaining. From within this group, there will be a lot of companies which have no major growth opportunities. So investing in them is not the best of the best idea, right? You can do even better than that. So we start focusing on, out of this group, which companies have large exposure to what we call large growth vectors. So growth vectors are externally driven things, which could be driven by technology, which could be driven by social conditions, cultural things. It could be regulations driven, but which are going to last for a decade plus, right? And the opportunity is large, and the companies are already capitalizing on that, which means they have a very clear-cut strategy on how to go for it. So these are the kind of companies we select from the multipliers, and we assemble a portfolio of 30 odd stocks, 25, 30, 35, from 5 to 7 growth vectors, different growth vectors. So just to give you an example of growth vector, it becomes confusing. So very simple thing is that now the focus is on fitness and wellness, right? Personally, socially. So nobody likes sugary drinks. So Coca-Cola traditional drink is struggling, and the so-called healthy drinks are in very high growth, right? Something like that. Now this is going to last for decades. This is not going to end tomorrow, that it was a fad. No, it cannot be a fad, right? Then there is technology, AI, right? Or forget AI is now, 5-10 years back it was the moving to the cloud, right?
Correct.
That was a huge growth opportunity, huge growth vector, which everyone could see. It was very predictable, and you could decide.
So tell me something. Typically what you'll see, right, is that your Capital Imploder group or folks within Capital Multipliers who may not have access to strong tailwinds will do M&A to say, hey, I need to, because instead of building a capability, right, you can do M&A. How do you factor that in, right? Because, for example, if you look at Coca-Cola, right, it's been acquiring healthy drinks now forever.
Absolutely.
Right? Which means that if you, and of course, if you're a, for example, I think, what was the, Odwalla, right, I think was the US company that Foos Beverage was the US company which Coca-Cola bought. So if you invest in Foos Beverage, right, you'll get some upside, right?
Absolutely.
That upside gets, because Coca-Cola has now taken over the upside by paying what they believe is a discount to the long-term trend.
Right.
How do you factor in M&A between that, imploders, multipliers group? Because the imploders are obviously also looking to try and get into a multiplier framework.
Of course. Imploders are going to do everything right.
Yeah.
Assuming they do everything right. Despite that, we consider them overvalued. So even if they do everything right and they are able to grow, even then you are going to get at best market returns in the imploders. And this is after So it's basically sometimes they're priced such that you have to grow at 20% for 20 years. And if you do all of that, then you get the discount rate, which is 9%, right? So it is that kind of, and if anything breaks down in the next 20 years and they're not able to do 20%, they're able to do 16%, then you get a huge price drop, which is why we call it imploder. So the way we do is, yes, we would actually be on the sell side there, right? The company which Coca-Cola wants to buy, most likely that would be in our portfolio if it's not recognized by the market yet, and Coca-Cola buys it. We get some Coca-Cola shares in return. We immediately sell them if most likely it is overvalued. If it is not, it's still a slow growing company possibly compared to the price it is. So we might still sell it off and buy something else.
Yeah. So where's FANG sat in your view across your investing framework over the last, say, half a decade or so?
Yeah. So we have FANGs at least from 17 or so. We had practically all the FANGs in our portfolio till August 24. So in August 24 rebalance, we took a lot of them out, or practically all of them out except Google, Alphabet, because at that point, Apple crazily overvalued. Well, I mean, it was still not that it would drop, but it was beyond our tolerance, the expected return, let me put it clearly, expected return for us from that was lower than the S&P 500, which means it's a sell, right? Why will I keep holding that? So Microsoft, Amazon, Apple, these were extremely overvalued. Others were also getting close. So we got rid of practically all of them. Now again, they've fallen and now they might be juicy again. That's a different...
So tell me, Vikas, right? You have a team, you have a lot of experience in this space, right? How does a retail investor look to implement like the framework? Are there simple heuristics that individual investors can use, or is it too complicated and you need a professional team, etc., right? Because individual investors, may be investing 5 lakhs, 10 lakhs, right? They can't go into a PMS where someone can manage their money. So what would you suggest there?
Yeah. So first thing is, don't invest in single stocks, or if you want to invest, I have no problem. But if you have, let's say, 25 rupees, don't invest 25 rupees in one stock. Invest 1 rupee in one stock and keep researching till you get to 25 stocks and you are able to manage 25 stocks or 20 stocks. If you tell me I want to manage 3 stocks and 7 stocks and Charlie Munger told so. So first thing, don't get lured into that. I have no problem, as I said, but you have to have the bandwidth to manage 20-25 stocks. How to research is very, very simple. You can do it actually. The problem is not the research part also. If you really understand, put the time in, you will understand. It's very basic stuff. That's not the problem. Problem is actually sticking to the methodology. Because you say, no, I don't have time to research. This is in front page news. I just have to buy it. Fine, buy it also. I have no problem with that also. Suppose you are going to buy 1 rupee of it, start with 10 or 20 paisa. Then, okay, I have bought it. Now I'll go and do research. At least you will not lose all your money. Right?
Correct.
So we'll just go very quickly. I'll give all the secrets out. Right? No, seriously. It is secrets are there. But I'm just revealing because I know nobody is able to.
Yeah, the issue is the discipline in maintaining it and being regular about it.
Yeah. So low debt to equity. So everything which is, let's say, for US markets, 75% debt to equity or debt to assets. So the reason is, the problem is there is no equity in many companies, right? Because of buybacks and all that. In US companies, most of the time, good companies will have no equity left because they've just done so much buybacks to return money, right? Because the ROE is very strong and they can't use it for growth.
Yeah.
Because best growth is what, 15%, and you're generating
Correct.
25%.
And you need to generate returns. So why don't we use?
So you keep doing buybacks. So there are negative equities. You can't do debt to equity in US markets. And they have all kinds of free screeners available, right? If you look little bit for US markets, all kinds of free data is available. Uh, so low debt to equity. So 75% debt to assets. Let's put it that way. Use interest cover,
Mhm.
4x.
Yeah.
Okay. But what covers what? So there is expenses and interest, and you want to cover it with free cash flow or OCF. So OCF plus interest minus interest, right?
Yeah.
That is what you want to, divided by interest. That's the cover you can look for. That's takes care of the destroyers. Okay. Next, you go for eroders. So look for return on capital. Again, return on equity, there is a problem because there's no equity.
Yes. You could return on total capital employed. Yeah.
Right? So you have to look for return on total capital, return on tangible capital, all kinds of variations you can do. But any of them you can use, and whatever is sensible to you, 10%, 12%, 15%, you use that as a cutoff. Anything which is less than that is not so great. And you can go for 25% also. The only thing is, if when you ramp up too crazy, then what is left is the best of the best, which is known to market also.
Yeah. Correct.
And then you will land up with
Yes.
imploders. Okay. So this is very simple. Return on capital is
Yes.
sufficient. Eroders are taken care of. And imploders. Now, I don't know the number, whether it's P, price to cash flow, whatever you want to use, but some number, maybe it's 30, maybe it's 40, maybe it's 50, above some number, you can define for yourself that this is overvalued territory, right? So I'm definitely not looking at this. Now, the reason I am going even to 40, 50 is because sometimes the current earnings, if you're using trailing earnings, then sometimes there is extraordinary costs or whatever, right? So the earnings are not normalized. So P might look 50, but actually once you normalize it is 25.
Mhm.
And the company is growing at 18%. So it's extremely cheap for P of 25. But it looks like 50 because last 12 months, there is some extraordinary expenses, right? So you have to look at those kind of things throughout the imploders. Now you're left with 100 odd companies. Look for your favorites. Look for what is got high growth. You don't want negative growth companies.
Yeah.
You don't want slow growth companies.
But essentially, though, even though the secret sauce is there, it's very difficult to keep the discipline to look at it every
Absolutely.
week,
Absolutely.
rebalance. That's the reason I think why people say, okay, fine, an ETF is easy, right? It's everything being done, etc.
Absolutely.
So
Absolutely.
that's the challenge. And how do you think people should look at the current high volatility environment, right? Because we're in a new normal, right? Where for the past, ever since the 2020, volatility has been king.
Yes.
Right? In this volatile environment, do you need to enter exit portfolios even using your scientific investing framework much more rapidly? Because the underlying drivers change, right? Massively.
No, absolutely. I mean, things, uh, see, like you rightly said, earlier we could hold the same portfolio for 2-3 years.
Correct.
And it would be fine.
Fine.
Of course, we reviewed every quarter, and maybe a couple of stocks would go out, couple of stocks would come in every quarter. But the typical thing, if I just gave it to you and you held it for 3 years, it would be still like a alpha generating portfolio. But what we saw is when they started increasing the interest rates, right? So December 21, he started saying, right, that I'm going to increase. And then he started increasing in March 22. And the markets, US markets started coming down, right? And at mid 22, maybe June or October, I don't remember, somewhere there, we had a massive rebalance where we got amazing companies, the best of the best, right? And this limit of ours of 25, 30, we couldn't stop there, and we ended up with nearly 39 stocks because all kinds of good companies are available so cheap. And we said, how can I let this not be in the portfolio? And this is as good as what we already have, or even better. But so whatever was not so good was thrown out, but we kept getting extremely good companies. All those imploders, normally, which we would love to have at the right price, they're not at the right price. And now they were all at the right price. And so
Yeah.
we bought huge loads. And we even got companies like Netflix, which we thought we'll never be able to buy at that time because, they lost 200,000 customers. They had a shrinkage of 200,000 in one particular quarter. So the market priced it below 100 billion. This is crazy. That around approximately 100 billion with 75 million US customers and huge growth in Asia, India, and all that, just because they had increased the price and they lost, and it market priced it crazily cheap. And we said, this is amazing. I mean, obviously, we did our calculations. So it was not just because it's down, we buy it. I mean, Meta, which had touched nearly $1 trillion, was also down to 380. I don't remember exactly, but 300 odd billion dollars, which absolutely didn't make sense for Meta, for the kind of user base, for the kind of revenues, for the kind of growth opportunities. So we had huge amount of such companies coming in, all kinds of best of the best. Like you think about it, Salesforce, Adobe, all of these are, you're just getting so cheap. You just buy all of them. So we had 39 stocks. And then August 24, our long held favorites, the FANGs also, we had to start reluctantly, but you had to let it go.
So Vikas, so what is your replacement for FANGs in your portfolio? Is there a group
Yeah.
that emerges?
Yeah. So the thing I talk about in August 24, we identified a small company called App11. Now, the funny thing is, for 24, the world's favorite, and I'm sure your platform you would have seen,
Yes,
the favorite stock was
correct.
You tell me.
NVIDIA.
Absolutely. Right?
Clearly.
NVIDIA.
Yes.
Right? And everyone would have thought that would be the best performing stock in the year. But the fact is, on NASDAQ, the best performing stock, NVIDIA was the second best performing stock. And App11 was the best performing stock. Now, we didn't know any of this at that point, right? This is data which comes out in January or something. What we just found is it's a small company. It's nowhere comparable to NVIDIA, right? It's a very small company, but it's into like some software related to apps, right? Advertising on apps and all that. And we found it cheap and we bought it. And it went 4x within 3-4 months by end of the year. While for the full year, from beginning of the year, it was 7x or something. So it was beating NVIDIA. And obviously, NVIDIA is a completely different animal, right? The whole world is dependent on it now and cannot survive without it. But the point was that even some of the largest growing companies, if the price is not right, and something which is not as crazily fast growing, but a decent growth, much better compared to the market or much better compared to that economy, and you're getting it very cheap, then you can make much better returns with the medium grower as compared to the favorite. So,
Right. Interesting opportunities, right?
yeah.
So what about the other piece that I think is interesting, which is we're in India, right? And you've talked about diversification. What's your view of US India dynamics, the need for diversification, and how do you view sort of the investing universe? Are you looking to recommend markets outside of US and India? If so, which ones? And then across US, India, what do you think, allocation should be?
Yeah. So first thing, I mean, we are a very large economy. We are likely, you know, let's investing is about the future. So it's a very near future that will be number three, right?
Yeah.
So we are one of the largest economies in the world. From that point of view, should you invest in India? Definitely yes. But should you invest only in India? Doesn't make sense.
I agree with that as well.
Yeah. You should diversify. You should diversify. I mean, it's that free alpha
Correct.
logic,
And
right?
correlation across the two markets has been dropping.
Exactly.
Right.
Exactly. And our studies show that it is practically zero. S&P 500 versus Nifty. I'm not even talking our strategy or anything. S&P 500 versus Nifty, if you do INR to INR or convert both to dollars, there is practically zero correlation. Okay. So you should have allocation to US markets. US is the largest economy in the world and largest market cap wise also. Lot of companies which are not necessarily only US economy companies, right? They are global.
Yeah, global companies. So you have exposure to many other markets.
Exactly.
Therefore, you have a diversification benefit.
Exactly. Huge benefit.
Whereas Indian markets, you're actually mostly localized to Indian exposures.
Absolutely. It's very, very local. While when you go to US, you're not investing in US economy,
Correct.
you're investing in the
Global
world economy.
Correct.
So you should have that diversification. See, most people are not even invested in Indian equities,
Yes.
right? They're in gold or real
Correct.
estate or all of that. So first thing is that fine, you start with Indian equities. I mean, if you're okay to do it, I'm happy if you do US equities first also. That's okay. But definitely once you're done with Indian equities, add US first. Don't talk about Brazil and China. That is ridiculous. First to US. Once you have enough US, which means 20-25% of your portfolio, at least, then we talk about rest of the world.
Correct.
And even then, no other emerging markets are required.
I agree. Because you have, if you think about it, right, I would say if you have the current number one economy and the future number three economy, right, you have a good two-horse race.
Absolutely.
Correct. Let's talk about one more thing. You talked about growth drivers, right, which are very important.
Right.
What are the technologies outside of the usual suspects, right? So AI, EV, we understand.
Of
But
course.
are there other growth drivers that you're very bullish about?
So, healthcare, right? That's the big thing. World is growing old, and the rich and old, right, together. So people are going to be old. They will need help on healthcare side. They have the money to afford for that, and so a lot of research is going on. So new molecules and new devices, right? That is something you don't get access to in Indian markets.
You
too
don't.
much.
Absolutely not.
And you get it in large numbers in US market.
This market, yes. And sometimes in the London market, because that's the
Of
other.
course, yeah, in other markets as well, but primarily US.
Got it.
So
Got it. So last question, because this has been a fascinating conversation, but I know you also have limited time. If you were 25, right, and you were starting investing,
right.
what would your advice be to your 25-year-old self to follow?
So this is something a very simple calculation which anyone can go and do. That if you save 20% of your income for next 30 years, let's say you're 25 or even 30, next 30 years, now you're 60 and let's say you're retiring, you will have and invested in equities. So why equities? Because the kind of premium on inflation, so whatever is the inflation plus 6% approximately across markets, you will see is the returns from equities, whichever market you choose. And if you do this calculation, so whatever is the expenditure today and you inflate it with the inflation, whatever is your assumption, plus 6% is the return from equities, you will end up with enough corpus to last you for next 30 years. So this is something very simple. So my advice is first save and invest the 20% in the riskiest thing which you think is risky. Let it be risky. Don't, my personal advice, don't invest and buy a house. Okay, first invest in equities. It will go up and down. Don't bother. Keep learning and keep investing, keep learning. Of course, initially you will lose money. That's the tuition fees. But eventually, let's say you start with 25, by 30 you will learn most of the basics, right? And stop losing money. But you will have the discipline of save 20%. Everything else you go and blast it out. You spend all the things. But first take out this 20. Don't tell me that end of the month I actually have plus 20% in the credit card bills. That is stupid.
Yeah, you have to live within a balanced budget, right?
Yes.
It's not all
Save it
the
first.
US government that can run an overdraft throughout your life.
Exactly. You're not running the dollar, right? So you first save your 20 and then spend everything. I don't care. Spend everything. Enjoy.
Thanks, Vikas, for coming on the show. We'll try and have you on again. And folks, I hope you learned a bunch of useful tips for investing that you can actually use in your own personal investing journey. And we'll be back next time.